Can you hear me now?
Yeah, perfect.
Cool. I am just going to share my screen. Can you see my screen?
Yep.
Cool. And the sound's all okay. Just doing the usual kind of sound check and visual check, and you can see my screen and you can hear me all right and all of that sort of stuff.
Yeah, let's check all the feeds. Yeah, look, yeah, YouTube's good, Facebook's good. We've got sound, we've got picture. I think we're good to go.
Okay, cool. All right, thank you very much, Josh, and thank you for inviting me on. I'm very proud to be, pleased to be supporting the effort to raise funds. I know that we're over the 80% mark, so we're very, very close to the target, and fingers crossed that we'll actually exceed the target. So that'll be a good result for this. So well done, Josh and team.
Perfect. Thank you very much. What I'm going to do is I'm just going to turn off my audio, turn off my video, just to help with the connection, and then I'll monitor the questions at the end.
Yeah, that's fine. And I'm going to likewise turn off my video feed so that I can also sort of focus on the slides. So just give me 1 second on that while I do that. Right. Okay. So I'm going to be speaking about structuring property joint ventures in order to succeed post COVID-19 and the coronavirus lockdown. Just by way of reminder, the links to the Virgin Money just giving Virgin Money page is on the screen. As I said, we're over the 80% mark. So if we can try and get that towards the target, ideally today, or if not latest tomorrow, that would be really ideal. So please do support. So what am I going to be speaking about today? I'm going to start off speaking a little bit about myself, my journey here, and why I'm been invited to speak for today about joint ventures and my experience and kind of what I'm seeing on the ground. And then I'm going to be speaking primarily about property joint ventures and the various tools that you can use, the various structures, and also some of the tax implications. Shaz and Joshua earlier mentioned a little bit about this, and I'll elaborate a little bit more. So I think it's a nice flow on from that. And then there'll be a Q&A session towards the end as well. So remember, if you've got any questions, please do raise them in the chat box in either Facebook or on YouTube, and Joshua will put them through to me, and I will try and answer them the best I can. If I can't answer all of them straight away, then I'm happy to get back to you either personally or on a live forum. Okay, so just quickly moving on a little bit about me. I was born and raised in Kuala Lumpur in Malaysia, where I lived for the first 22 years of my life. I came here in Essex to Essex of all places, but I came in 1998 in order to finish off my undergraduate law degree, and then I stayed on and did the Masters in Law at University of London, and then a postgraduate diploma in legal practice as well. So my dad said to me when I wanted to go on to do the PhD, he said, no, that's fine, that's enough. You go on to practice and start earning some money now. So which is what I did. I went in to start training, my vocational training, and qualified as a solicitor in 2003. So I've been at this for quite some time. In 2007, my wife and I started investing in property. So from the year, you'll note that we started investing at the best time in the market, which is just before the crash. So we had a period of time when we were in slight negative equity. So, but fortunately, we were investing in Zone 3 and up to Zone 6 in Central London. So the market recovered relatively quickly. So we were forgiven by the market in some ways. So we've carried on with our building our property portfolio, and it's still around Central London and a lot in Croydon. Then in 2009, again at the peak of the recession, I thought it would be a good idea to start a law firm business, which is what I did. So I launched Matrix Legal in May 2009, and it was a boutique law firm specializing just in property. So a little bit about Matrix, as I said, started in the worst recession in recent memory. The plus side about starting, and I think it's quite relevant during this time as well, as we are in the lockdown and the state of the economy that will prevail post lockdown, is that it is actually quite a good time to launch a business, because everyone's thinking, everyone's looking for new ideas, everyone's looking to do a deal. So I certainly found when I was launching a business in 2009, a lot of landlords were very keen to have somebody come along and take up office space. A lot of suppliers were very keen to do deals, and clients as well were looking to at different suppliers in order to see what's out there, and diversify their supplier base as well. So I started having some relatively good success in the early stages. I started acting for the landlords of 4 out of the 5 corners of Piccadilly Circus, acted for quite a number of shopping centers, and landmark assets, including the London Trocadero, Queensmead Observatory Shopping Centre in Slough, the Burberry HQ in Knightsbridge, and a couple of buildings in Canary Wharf as well. So here are some pictures of the properties that I've acted on. Bubba Gump Shrimp Company was a letting for the land of the Trocadero. That was quite an interesting let. It was let to a Kuwaiti conglomerate. They were looking to create a trophy asset of business in central London. So they brought over the Bubba Gump Shrimp Company franchise from America, and spent quite a lot of money establishing that business. What is particularly interesting to me on that particular letting was that the annual rent for a year's worth of rent for that particular site was 1.2 million. So I kid you not, 1.2 million every year is payable for that particular site. And this is quite a few years ago, so the rent would have gone up since then. And the rent deposit alone for that was £300,000. So this was big business, big properties with a very, very large rent. I've also acted for the Lily White's building on the Piccadilly Circus. We did also a mast letting at the top of that building. You can't see it in this picture. It's kind of hidden at the back, which is one of the conditions that it wasn't very imposing when you look at it from the front. But there was a letting of a mast for a mobile phone operator on that building. The Global Radio building in Leicester Square, where you might, as you can see from the picture, there's Capital Radio, LBC, and a few other well-known radio stations are housed there. So I've acted for the landlord on that building. Some other ones that I've acted for, as I mentioned, Queensmead Observatory Shopping Centre in Slough, and also St. Nicholas Shopping Centre in Sutton. The Queensmead Observatory one is interesting. We had a rejig of the anchor tenancy by TK Maxx. So they were surrendering parts of the property that they were already occupying in order to then take on some other bits to add on to the occupancy, which then made them the anchor tenant in Queensmead Observatory. So that was quite an interesting piece of work. They instructed city lawyers, and city lawyers tend to have a habit of throwing quite a number of bodies, so to speak, number of lawyers onto the project, and that tends to drag out the process a little bit longer. But what I started seeing from retail, doing quite a lot of retail premises, and this is going back 2012, 2013, thereabouts, was that, there were signs that the market was already slowing down, lettings were already slowing down. So I started to peel away from retail quite a number of years ago, and moved on to more development-focused clients. So, for example, this one on the left here, when permitted development rights was first being discussed and consulted upon, so even before it was actually introduced, my client bought, I helped them buy the site on the left, which is a former Age UK HQ building in Norbury. That was done on exchange with delayed completion. and the completion actually took place a year later, so a year after exchange of contracts. And by that point, permanent development rights had been introduced already, and they could go ahead and just convert it into and convert it into residential apartments, which is what it is now, and is on a private rented sector scheme. That block is still owned by the landlord who acquired it, and yeah, and that was quite an interesting project. The one on the right is the Mini Cooper um, uh, showroom in on Park Lane near Mayfair. I've done some work on that. So I grew Matrix relatively quickly. We and But as I said, we started pivoting away from retail. I went into high volume conveyancing, and at one point, we were doing about 700 completions a year, so something like 55 to 60 completions a month. That was very hard work. It's very stressful. There's a lot of pressure. But I also grew a lot as an entrepreneur that way, which I think is the best way to grow when you're under pressure, when you're under stress. Sometimes that's the best way to grow. Certainly took me outside of my comfort zone. I grew, very, very, very rapidly that way. But again, there, I found that, I had some limits as well in terms of acting for lender panels, because you were still a relatively small firm. We couldn't act for a number of the lender panels or number of the lenders, because we didn't have the number of partners and what have you, and also didn't have the other practice areas. So I actually then spent about 18 months looking for a merger partner, and then sold the firm to RHW's listers in just last year, 2019, just a year ago actually, and I've since moved on from RHW's listers to another firm. 2011 to 2014, my wife and I also ventured into property trading. So in the good old days when we could buy from auction through cash and bridge, and then refurb it, and then sell it on through an agent. So we were doing that. That market then started changing. And now actually it's much better to sell through the auctions rather than buy through the auctions. There are still some deals around, but we're finding the other ways is more profitable to a certain extent. Um, then I launched tariqmubarak.com as well, where I do via that website. I offer some legal and consultancy services. I joint venture on property deals with some of my clients and other individuals. I offer some coaching and mentoring because I've been asked to. That doesn't form a big part of what I do, because I'm a solicitor first and foremost, a property investor and developer secondly, and then the coaching and mentoring comes along because I have a amount of knowledge that I have gained and experience that I've gained. So sometimes people call upon me to provide that coaching and mentoring, and also consultancy services as well. My wife is also a planning consultant, so sometimes we joint venture with clients and friends on the legal side and the planning consultancy side, and also I have access to finance and what have you. So that tends to form some of the joint venture expertise that I provide. So let's move on to property joint ventures. Now, why would you want to enter into a joint venture in the first place? What I have found both in 2009, and I think we're starting to see a bit more of that now, is that debt finance is becoming a little bit more difficult to come by. So for example, loan to values have reduced. Banks want a lot more skin in the game. They want better cash flow. They want the investor, the borrower, to have a lot more funds tied in the deal itself. And as investors and developers, our cash is finite, and we're going to struggle to fund all of those deals ourselves. And there will be a lot of deals coming up in the market, because there's a lot of opportunities going to be around as the market tightens up and liquidity drops. So in order to capitalize on those deals, the best way is to arrange to let more funds, and if the banks are not lending, then joint venture might be the way to go. So it's very reflective of what we saw in 2008 and 2009. But there were a number of different creative strategies that were used, a little bit less on joint ventures. My personal view is that whilst we'll see some creative strategies being used as we come out of the coronavirus lockdown, the more prevalent will be property joint ventures. So, which is why I thought I'll speak about that and how to get it right, so that you're avoiding issues for yourself going forward. The other benefit to doing a joint venture is you're hedging against market movements. And what I mean by that is because if, so long as there's enough margin in the deal, even if the market was to drop going forward, the only thing that's really being risked there is the investor's equity. Now, I don't take that lightly, but it's a lot easier when you have a joint venture partner who's in it with you, who's got the understanding that there is a risk element to this, as opposed to just pure debt finance, where the banks say, regardless of how the market is performing, we expect you to repay this loan with the interest and all the costs associated. And so, especially if you've got bridge finance, that's a very big gray cloud that's hanging over your head. That's a very big boot that might be on your neck. And so sometimes going down the joint venture equity route might be the least stressful way of structuring a property transaction. So it's certainly a good way to hedge against market movements in that way. So as I mentioned, it's more of an equity play here rather than debt finance, but it gives you a lot more flexibility in that regard. Now, choosing the right structure is quite important. So I thought I'll go back and start with a little bit of the basics to a certain extent in terms of what exactly is a joint venture. Now, in its simplest form, the definition that I've come up with is that it is two or more individuals or entities coming together to collaborate for profit or not for profit. And I'll speak a little bit about the not-profit element of it, because you've seen recently, for example, the likes of GlaxoSmithKline and another large biocare company Sanofi, I think it was, who are coming together to collaborate in order to find a cure for the coronavirus. And previously, we've seen in cancer research, not-for-profit organizations coming together in order to collaborate, and eventually that led to the merger of the organizations itself. So you see that a lot in not-for-profit, in the not-for-profit sector, but certainly in the private sector, for-profit entities. There's a lot of it that goes on as well. So that, in very basic terms, is the definition for joint venture. The structure you can adopt, excuse me, a lot of people tend to, as Shaz mentioned earlier, most people tend to default to the limited company route, which is where you find a joint venture partner, and you and them go into a limited company as shareholders, maybe as directors, and that then essentially becomes your joint venture vehicle. But joint ventures can actually be purely contractual, and I'll touch on some of that, elaborate on some of that a little bit further in the next slide. But it could be just purely contractual. So there's no separate entity that's created. It is just a pure contractual arrangement between the joint venture partners. It could be a partnership or an LLP, as Shaz mentioned in the previous talk. It could be, as I mentioned, a limited company. And here's a surprising one. It could also be a unit trust. Now, you've heard of real estate investment trust. And that would be the structure that you would set up, where you're essentially selling off, like almost similar to stock, but units in the trust itself in order to raise the capital, raise the funds for the particular project. Now, unit trust is quite an advanced structure, quite an advanced strategy. So I won't go into that in a great deal of detail in this particular webinar, because otherwise we'll just run out of time. But if you're interested in that, get in touch via my website, and I'll happily speak more about that. So I'll go into the contractual partnership or LLP and limited companies a little bit more now. So in terms of contractual structures on your screen, you will see the ones that I see quite a lot of at present. These are the ones that are quite common. I mentioned earlier that in 2008, 2009, and even slightly prior to that as well, we saw quite a few of these creative strategies. For example, lease options, purchase lease options, they're known as, or assisted sale agreements. You know, those were quite common. And I mentioned, for example, that former Age UK HQ office that was converted into apartments on an exchange with delayed completion. Um, so, you know, those are some of the contractual arrangements you can have. Options I see a lot of. I do a lot of those on a weekly basis, and I think we'll see a lot more. I mean, certainly in the last week, 10 days, I've started seeing a lot more conditional contracts as well. And a conditional contract is where um, so if you take a bog standard conveyancing transaction, you have a contract, and then usually a week or 10 days later, you're completing. There's no conditionality to it. It's just, here's the fixed exchange date, and here's the next fixed completion date, and there's nothing to do in between apart from, you know, perhaps in some procedural matters. But with a conditional contract, you're actually saying that, look, I'm going to complete on this particular day, let's say a week or 10 days or 1 month or 2 months later. But completion is conditional on something happening. That something could be, for example, me getting planning permission, me getting funding in place. But recently, in the last week or 10 days, the conditions that I'm seeing is that completion will take place, for example, four months after the UK government removes the coronavirus-linked lockdown. The other condition that I've seen recently is, we'll complete 2 weeks after we sorted out our bank funding. So, I think that in the post-coronavirus lockdown property market, we'll see a lot more conditional contracts, a lot more of these type of contracts in order to come out, in order to structure deals going forward. And so, these are some of the things that I think you ought to be thinking about. There's quite a few ways you could skin a particular deal. And here are some options in terms of contractual structures themselves. If these are of interest, get in touch, and I'm happy to run through those in a little bit more detail on each one as relevant to to your particular deal. Or if you've got a question now, you need to put them into the chat box, and then I can answer them during the Q&A session as well. I wanted to speak a little bit about the pitfalls that you ought to be looking out for when you are thinking about going into a property joint venture. And these are things that I see quite commonly, when I'm acting for clients who come to me and say, look, we want to structure this joint venture. And I thought I'll share some of those experiences with you. One of the first things that I tend to notice is that a lot of times, those who are entering into a property joint venture come up with heads of terms, which is absolutely the right thing to do. You need to have a good set of heads of terms prepared right at the beginning, right at the outset, which sets out, these are your expectations in terms of what you expect to achieve with this property transaction and what have you. But the difficulty that I have is that the heads of terms tend to only focus on the property deal itself. So, for example, we're buying this block of 8 flats. We are going to refurbish them, and then we're going to sell them, and we're going to split all the costs 50-50, and we're going to split all the profits 50-50. Great, fantastic. That absolutely should be the right way that you should be thinking about structuring the property transaction, should be thinking about, some of the costing size and what have you. But the heads of terms really only works in terms of the property deal itself rather than the actual joint venture, because there isn't enough detail in terms of what the partners are going to be working through in terms of the joint venture side of things as opposed to the property deal side of things. There's always, you have to bear in mind that there tends to be always two sides to this coin. One is the deal, the property itself, what is the plan there, what's going to be the the modus operandi in terms of what's going to be happening to the property, what's going to be the exit strategy. All of that should be definitely included as one part of the coin. The other side to the coin is also about the joint venture. That needs to also be very, very robustly written. One of the things that you ought to be, first and foremost looking out for is in terms of the chemistry with your joint venture partner. Do you share the same values? And do you even know what your values are and what your prospective joint venture partners' values are? If you have values that are diagonally opposite to each other, then you can expect that those values are going to coincide, not coincide, they're going to have probably come into loggerheads at some point, because when you go into business, it does get challenging. Sometimes you will have stressful situations if you have the wrong set of values, or somebody doesn't share the same values as you. How are you going to work it out? So you got to try and suss out what their values are and whether it matches yours. Personality, do you get on well with your joint venture partner? Are they the type of person who's going to be able to communicate with you well and resolve matters, or are they going to become aggressive? Are you comfortable with a certain level of aggression? So that's quite important to try and figure out. Communication styles also very important. I've seen instances where things have gone pear-shaped, and one joint venture partner likes to write, so sends these really, really long emails about what they think about a particular point or particular issue, and the other joint venture partner doesn't like writing, doesn't like reading long emails, but prefers to talk it out instead. So that mismatch in communication style sometimes might cause a bit of friction. And whenever there's a pressure cooker situation of a business transaction or a property transaction, those little friction tends to be put under a magnifying glass and tends to get blown out of proportion. So you got to suss all of these things out as early as possible. You also want to check about your credit profile of your joint venture partner. Now, if you're and this can be quite a touchy topic. Trying to ask your joint venture partner for them to reveal their credit profile to you early on in your relationship is going to be quite touchy. And but it's something that you got to do, because if they've got poor credit and there could be some difficulties down the line which might affect your ability to raise finance, or their bad credit catches up with them and then affects the way that they behave to you and on the deal itself. If they are pushing very hard for the deal to be done very quickly and sold very rapidly so that they can clear their own debts, how is that going to affect you and your plans and the property's plans? What are the market changes, and the property can't be sold that quickly, they're coming under pressure. So that's something that even though it's difficult, I think it ought to be considered. I think it's important to be established as early as possible. The other things to figure out, from an operational perspective, who's going to actually be dealing with the mundane stuff, the banking stuff, the accounting entries, and keeping on top of that, who's going to be dealing with signing off on checks. These are all things that you need to discuss and agree at the outset, and it needs to be documented either in the joint venture agreement, or if it's a limited company, in a shareholders agreement. So all of these things, it sounds mundane, but you have to discuss them, and you need to really figure out who's going to be responsible for what. Because if, for example, you agree between yourself that your joint venture partner is going to be in charge of the banking, and then decides to go and go skiing in northern Italy, and then is suddenly under lockdown and is not able to sign checks, then what's going to happen with your project? How are you going to make payments and stuff like that? So is there a second level of signatures that you need to have up to a limit, or is there a process that you agree in terms of how do you discuss and agree a process in order for checks to be signed and stuff like that, and payments to be made? So all of those things, even though they're mundane, they need to be discussed and agreed. Now, just from a tax and compliance perspective, I wanted to touch briefly on the tax implication. I know Shaz and Joshua had a lengthy discussion about this before, so I won't go into it in too much detail. But just a few things to bear in mind in terms of structure and also in terms of the tax implication. So general tax trigger rule is that when asset ownership changes, that's when tax usually becomes payable. So if you think about the situation when a property is purchased, that's when stamp duty will be payable. When a property is sold, it's usually capital gains tax, or it could be corporation tax. So so the general tax rule there is that, you know, when ownership changes, that's when there's a trigger for tax. So the reason why I mentioned that is because sometimes I come across clients who say, look, you know, I've done a deal with the landowner. We're going to go into a joint venture. And what we're going to do is the landowner is going to transfer the property into the limited company. And then, you know, they'll be allocated X number of shares to the value of the land. And I'll have the rest of the shares. We're going to develop the land. We're then going to sell it and then split the profits. The downside with that approach is that, you know, when that property transfers from the landowner into the SPV company, there is a tax trigger there. There'll be stamp duty by the limited company, and there will be either capital gains tax or corporation tax that will be payable by the landowner or property owner. So perhaps then, you know, you in terms of choosing the right structure, you might decide, well, in that case, perhaps we shouldn't have an SPV and transfer the property into that company. What we ought to do is just have a contractual joint venture. So rather than having a separate entity, either a partnership or LLP or a limited company, and put the property into that structure, just keep the ownership where it is right now and just have a contractual arrangement between the landowner and yourself as the joint venture partner. And, you know, you might see this through a promotion agreement. You might have a joint venture agreement. You could have an exchange with delayed completion. So there's quite a few different contract structures you could have. And in terms of security, you could always take a first legal charge on the property, or enter a restriction. And there's a few other securities that you can enter into, which will protect your rights under that contract. So there isn't that much of a concern in that regard. Now, the other thing to think about is when you're choosing the right structure, how those funds come into the joint venture. So, for example, if you're thinking about buying a property and you're going to develop it, those funds that are coming into that structure, if you've done a joint venture with a cash-rich, high net worth individual, should those funds come in as capital stock or loan stock, or capital funds or loan funds? So, you know, in the previous presentation, there was mention of, you know, intra-company loans, and certainly, you know, if you make the investor lends the money into the limited company, for example, and that money is then repaid with interest, there is some tax benefit there because it reduces the profit of the entity and therefore less tax to pay. But then, you know, if you introduce the funds into the company or the joint venture structure as debt, and you're raising finance from a lender, the lender may not be very happy that they've got this other debt stack sitting in the company or the LLP. They would prefer for that to be converted into equity instead. As you know, I mentioned earlier about lenders preferring borrowers to have skin in the game. So, you know, they would prefer to see that those funds coming in as capital, as equity, rather than as debt. So that's something that you need to think about. And also the point about ownership. If, you know, I mentioned earlier that whilst you're thinking about the tax trigger and the tax implication, it might be better to keep the property, the land, in the name of the landowner itself, so that you're not triggering tax in that regard. But you know, the lender may not be very happy to put the loan on the landowner themselves, although they're getting first charge security on the land or the property. they don't have you on the hook because you're not a borrower, just a landowner. And so there, it might be that because you're raising finance, it's better to actually transfer the property into the SPV itself. The point that I'm making is that you got to think about all the various different factors that influence the deal. So tax being one of them, the lender and finance requirements being the other, administrative burdens in terms of compliance, annual compliance, filing requirements, all of that needs to be factored into when choosing the right structure. It's not just, right, let's default to a limited company because that's what most people are doing. That's, in my view, not the best way to do it. Um, there are, for example, quite a lot of benefits of doing it through a LLP. There's no, for example, double taxation effect when you use a partnership or LLP. What I mean by that is, so if you think about the taxation stack, when profit is generated within a limited company, the limited company has to pay corporation tax on the profits. And then once that profits are then fed up to either the holding company or the shareholders, there's usually a second set of tax there. So in the form of, when the dividends are paid over to the shareholders. Whereas if you had an LLP, there isn't that second hit of tax. An LLP doesn't have corporation tax that it pays. There is no secondary tax at the LLP level. It's only when a distribution is made to the LLP member partners that a tax trigger happens. So it's usually, if it's an individual member partners, it will be income tax that they would pay. Or if the member partners are corporate entities or limited companies, and you can have corporate entities as LLP member partners, then they would pay corporation tax when those profits come into the limited company. But the LLP itself doesn't pay tax in itself, so you're avoiding a second hit on tax there. So it might actually be better to use an LLP, and certainly in some situations, for example, I mean, even a simple thing like, when you lease a car, especially an electric car, there's a lot more benefit to be had in using an LLP rather than a limited company. So something to bear in mind. Certainly, speak to your accountant before you choose a relevant structure. Annual compliance requirements I've mentioned. The other thing to bear in mind with regard to annual compliance requirements is, so I mentioned that you need to have a contract in place, either a joint venture contract, or if you're doing a limited company structure, then you usually have a shareholders agreement at the back end, or if it's a partnership, if it's a LLP, you'd have a partnership agreement. Now, with the articles and memorandum association, which are some of the basic compliance requirements that you would have for a limited company, and a partnership agreement for a LLP, those are public documents. So you probably wouldn't want to divulge too much in terms of the joint venture inner workings in those documents, because you don't want them to be public. And so you might opt for some of those inner workings to be kept within the shareholders agreement itself. So that public versus private discussion, how much do you divulge in terms of, because you don't need to have a shareholders agreement. You could put everything into the articles and memorandum of association, but it becomes a public document, and you might not want to have it that way. So things to factor in mind when you're choosing the right structure. Now, some of the other things to consider when you're having a joint venture agreement or a shareholders agreement is what I like to call the shit hits the fan clauses, because you will have situations when things go pear-shaped, and at that time, what do you do? Should you litigate? Should you mediate? Or should you meditate? Now, I'm a transactional lawyer. I like doing deals. I like win-win outcomes, so I don't tend to recommend litigation. The downside, in my view, with litigation is that there's always one winner, one loser chosen by or decided by a third party. In this case, usually a judge. But there's always one winner, one loser. Mediation, I tend to prefer more, because mediation tends to result in more of a win-win outcome for both parties. I think, just leaving it to meditation and sticking your head in the sand is certainly not the best way to go. So make sure you're incorporating some of those provisions into the joint venture agreement or the shareholders agreement very carefully, in terms of how do you resolve problems when it comes up. You need to think about, if you've got a 50-50 type situation, so 50, both of you are contributing 50% cost, 50% profits are being shared between you. What happens when, there's a disagreement and there's deadlock? Your voting rights are 50-50. What's going to happen there? You need to be thinking about those things when it goes into the joint venture agreement or shareholders agreement. If you're having a number of shareholders, for example, coming into the limited company, or you're the minority shareholder, do you want to have specific minority shareholder protection for either yourself or your minority shareholder, because they're going to be outvoted? So stuff like that you need to think about. Who's going to have decision-making authority on the day-to-day stuff. So what I mentioned earlier about operational duties like banking and accounting and stuff like that, is there a limit to decision-making? So for example, you set a limit of, let's say, any expenses up to £2,000 with an aggregate of, let's say, £10,000. One particular director can make that decision by themselves without having to consult the others. That decision-making authority needs to be considered, needs to be discussed, and then needs to be put into the agreement, either the joint venture agreement or the shareholders agreement. And the duration of the joint venture is something that I think is very important, but not usually incorporated into the agreement itself. So sometimes it can go on indefinitely, but you see that situation where, for example, the plan is to sell the property within 12 months, but the market turns and it's going on to about 18 months. I've heard that. I was asked to consult on a project that was meant to have completed in 2018 and still not bloody finished yet. So, and there isn't like a duration of joint venture clause in the contract. What happens there? So stuff like that needs to be thought about and needs to be incorporated into the agreement. What is going to be the exit? Are you going to refinance the property? Are you going to sell the property? Those needs to be put into the agreement itself. In terms of if, for example, one shareholder wants to leave a little bit early, I'll come on to that in a few minutes. But how do you cater for that? And if somebody has left, for example, a shareholder, you has had a falling out or a change in circumstances, and they say, right, I want to leave, and you're replacing your joint venture partner with another joint venture partner, do you then want to incorporate some anti-competition clauses into the agreement? I've seen the situation where a joint venture partner comes along, invests in the project, invests in the deal, has a falling out with the other joint venture partners, and then walks off with the goods. In effect, they walk off with the deal. So you want to have you want to be careful about anti-competition situation like that, and protect yourself. Distribution of profits. I'm running through.
Hi there, Tariq. I'm just going to have to quickly jump on just because, we've just run over time.
Okay.
So we're 32 past now. What we have to do is, don't have time for questions, unfortunately, this one, guys.
Okay.
If possible, because there's a lot of valuable content here, and I, for one, I need to see the rest of this. If possible, would you be willing to share the presentation in the Property Conference Facebook group, just so that everybody can go through it? And also, there's a couple of questions on the Facebook feed and on the YouTube. If possible, would you be able to look at those and see if you can help anybody out on those?
Yeah, happy to do that. Yeah, no problems at all.
Yeah, perfect. Thank you very much for your time. I've learned a lot through that, and I've got pages of notes. Again, I've got quite a few pages from these past couple of days, and that was really helpful. Lots of people enjoying that, and saying there's a lot of stuff that they can really take into account.
Cool. Thanks very much, Josh. Thanks for having me on, and wish everybody well, and hopefully you guys donate as much as you can for the cause. Thank you.
All right, perfect. Thank you very much.